Hey everybody, it is good to be here. It is Friday, and that means it's Advanced Options Day. I'm glad to be here as we move on in our series. Week by week, we've been covering a different strategy that we cover in Advanced Options. This week, back ratio spread. So we're getting to some of the a little bit more advanced strategies here. This is just a reminder, a more intermediate level class. So I kind of assume you know some of the basics of options as we go through this, but we're probably getting near the end of our series. Last week we had a little interlude. I was out of town and I asked Mike if he would just kind of cover a tutorial on the risk profile tab, the analyze tab, because we use that all the time in here, and I think it's important to know. So you can always check that out. I put a playlist link in the chat for those of you watching live. If you're watching on a recording, just go to the YouTube Trader Talks Schwab channel, and you can find the playlist for this class, and you'll see various strategies, various playlists for the advanced options class. We cover in this series, you'll see the different strategies we've covered. I'm joined by Connie Hill helping me out in the chat. I always appreciate Connie. She's very knowledgeable with options. And so between Connie and myself, we'll try and get your questions answered. You can also follow each of us on X at Brentmore CS, at Connie Hill CS. Let's go through the disclosures real quick. Options do carry a high level of risk and are not suitable for all investors. The information today is for general informational purposes only. It's not a recommendation and it's not endorsement of any particular security, strategy, or chart pattern. Schwab does not recommend the use of technical analysis as the sole means of investment research. Paper money application, which we will be using, is for educational purposes only. And I'll be going through specific trades, looking at specific stocks. Those are not recommendations. They're just examples. All investing involves risk, including potential loss of principal. And short options can be assigned at any time up to expiration, regardless of the in-the-money amount. And no guarantee of an execution of a stop order that is going to be at or near the stop price. Okay, you see some familiar names in the chat. We're glad you're here. I was out last week. I've been out on vacation, but I am back today. So it's good to be back with you. And let's just take a quick look at the markets. So what I want to do is I want to talk about, just quickly look at the markets. I want to talk about the basics I'm going to do what I've done with other strategies in the class. I'm going to kind of give you a quick data dump at the beginning of various attributes of the particular strategy, today back ratio spreads, and then go through some example trades on that. And then hopefully we'll have time to manage just a couple trades from the past in this class as well that we need to, that need a little tending to there. And if you are interested in trade management, I do a lot more of that in the Managing an Options Portfolio webcast that occurs every Wednesday. This is the market. You can see S&P 500. Hey, you know what? We've had a few kind of iffy days. We're down about a quarter point here today on the SPX. But, all in all, you'd have to say this is a fairly strong trend that we've had on there. And you can always look at those trends if you want to throw on moving averages. And here's a 20 and a 50-day moving average. We're right at that 20-day moving average right now. We'll see if we get a bounce on that. Potential resistance, this purple line represents an all-time high on that SPX. Probably if you scroll through a bunch of stocks, you're probably going to find that, just randomly, probably most of them have been a little bit more bullish lately, just because that's what the trend of the overall market is. And the strategy that we're going to talk about today can be either bullish or bearish. Typically, if we're looking for bullish strategies, most technicians would say we're going to look for something that's more of an uptrend. And if we're looking for bearish strategies, we're going to look for something more that's of a downtrend. That's the traditional technical analysis approach on those. But ultimately, you have to decide what stock you're bullish on and what stock you're bearish on. Okay, so we're going to talk about back ratio spreads. Kind of big name, sounds complicated. It's not that bad if you break it down a little bit. And so one thing let me just mention this. You can use use calls or puts, okay, or puts. And in fact, in parentheses next to these, let me just say calls, they're going to be bullish in this case. A callback ratio is going to be bullish, or puts in parentheses, I'm going to write bearish because a put back ratio spread is going to be bearish. What makes it a ratio spread? Well, a ratio spread means you have different numbers of long and short options involved. Now, you may be going, back ratio spreads, is there such a thing as a front ratio spread? Yes, I'm planning on tackling that one next week. With a back ratio spread, you have more long contracts than short contracts. Okay, so that's what makes it a back ratio spread. More long contracts than short contracts. Now, in general, we try and shy away in this webcast from kind of naked short options. In this case, we're going to have more long contracts than short contracts, so that makes it easy in that regard. In that way, we're limiting the risk on that. And that's, I kind of like the idea of limiting risk. Of course, there are risks on that. Now, one of the consequences of more long contracts than short contracts is they're going to be more expensive than a front ratio spread. A front ratio spread, we're going to have more short contracts than long contracts. Okay, but unlimited profit potential, at least in the case of a, helps if I have an R in there, in the case of a call profit potential, in the case of a call front ratio spread, call back ratio spread, let me just change my spelling there. Profit, that looks like it's, I don't know why that's giving me, I doubled it. That's why it's giving me a red mark on there. Profit potential. In the case of this, in the case of call spreads, and in the case of a put back ratio spread, then instead of unlimited, it's going to be a large, generally a large profit potential. So that's kind of the nice thing about it on that. Let's keep on looking. So the max loss you can achieve is to the out of the money side of the equation. In other words, for a call, out of the money is going to be a lower price. And so if the stock goes, if the stock goes down, we're going to be, that's where that's going to hurt us there on that. If the stock goes below our strikes, that's bad news on that. Okay, so let's keep on looking. So I'm going to give you a typical construction and one that we're going to use in our class for this kind of example. It's not the only construction though. So as long as you have that ratio in there, it's going to be a back ratio spread. But the typical construction that we're going to use is one at the money short option and two in the money. Why that stopped? In the money long options. Okay, that's the construction that we're going to use in this class. But remember, you can change that if you want. In fact, well, I'll talk about various ratio spreads in just a minute here, but that's what we're going to do. And here's something that you may have heard of. Maybe you've heard of a zebra trade. Have you heard of a zebra trade? And that's just one thing. One way to do it is to often we seek zero extrinsic value, okay? And come on, extrinsic value. My typing skills need some improvement there. Often, and I'll show you how we can achieve that. And when we say zero extrinsic value, we're gonna try to mean that the extrinsic value of the short option is equal to the extrinsic value of the two long options together there. That'd be a zero extrinsic value. So, so they can be abbreviated or kind of an acronym as a zebra. Zero extrinsic value back ratio. I don't know what the A is. I don't know if there's an A, if the A stands for anything, but that's a zero extrinsic back ratio. You don't have to do them that way, but if you ever see that referenced, I want you to be aware that this is what they're going to be talking about, and we're going to try and do that today in our examples there. Okay? Yeah, uncapped is Chris said. So when we're talking about max gain, we're saying uncapped max gain on that. In the case of a put back ratio spread, the cap is if the stock goes down to zero on that. Okay, it can be close to a 50-50 probability. Okay, in other words, the break even is likely going to be fairly close to where the stock price currently is. So that's kind of a good thing, right? I mean, obviously we like higher probability, but if you have something with a large profit potential, close to 50-50 probability, is pretty good. And there is okay, as I already mentioned, high upside, and we'll see examples of this, but the downside is limited. Downside is limited. Okay, now it could still be substantial, and sometimes this will be considered what we call a stock replacement strategy. In other words, if you're considering a stock trade, you may look at this instead. I'll get into that a little bit more. They're not exactly the same, right? This is not the same as buying the stock. And one nice thing is on this can limit your downside more than the stock, but there is some other downsides too to this, and it certainly is not a stock in itself. I'm going to get into that just a little bit more in just a second. Typically, one of the downsides is negative theta. Typically, negative theta is what this is going to be. It's going to be positive vega. In other words, it tends to improve if implied volatilities go up. And deltas often near 100. Now, deltas on a stock, 100 shares of stock would be 100. So this often we're getting close to that with one of these. And that kind of is the reason why sometimes people will call that kind of a stock replacement strategy on that. Okay. And Chris says, I think the zebra in the A is to make the acronym cool. Yeah, I think so. It makes it roll off the tongue if you can say that. Let's see, I had some other points here. Let me just make sure I want to hit the points. Oh, here's the other thing. You can do various ratios. Okay, so the ratio that I expressed earlier was a 2-to-1 ratio. Okay, 2 long options, 1 short option. But you're not limited to that. For example, you could do a 3-to-2 back ratio spread. Okay, that would be 3 long options and 2 short options. And if we have that, anytime the long option outnumbers the short options, you're going to have the potential for a bigger gain because that one long option is going to be uncapped there on that. So you can do various kind of iterations of that, variations of that, and even though we're going to stick with the 2-to-1 today. As in terms of expiration date, really you can do any expiration date on these, but I'm going to say, but watch liquidity and consider time frame objectives. Okay, what do I mean by that? If this is something where you're looking for bigger a bigger gain, let's say as a trend, you think the trend is going to continue for a while, and you do the expiration date out 3 weeks, well, by definition, the thing is going to expire in 3 weeks. So that's not going to work very well, right? So consider that. Consider what your time frame objectives are, maybe your technical analysis tells you what you think the stock is going to do. Also when I say watch liquidity with expiration dates, a lot of times the monthly expiration dates have better liquidity. The weekly expiration dates often have less liquidity on those, bigger bid-ask spreads, lower open interest on those. So those are some considerations there on that. Also consider, as we're talking about this, remember, there is assignment risk on these. So as we get closer to expiration, where we have assignment risk coming. Okay, so often consider, I mentioned this before, a stock replacement, got an E in replacement, but consider, but not totally. And one reason is that doesn't pay dividends. So you're going to have no dividends is one thing. One difference between owning the stock versus doing this. There is an expiration. These may be more volatile. Option prices may be less liquid. So there are differences here there you need to consider. So when we say stock replacement, I don't want you to confuse that and think that it is just totally a replacement for all your stock there. Okay, let me just see. Do I have anything else written now? Oh, when are we going to exit? Okay, we're going to exit in this webcast. We're going to exit on stock targets. In other words, if the stock hits a target price or if it goes down to a particular price, we're going to look to exit. Maybe that's a support level. Remember, when I say stops, stops are not guaranteed, okay? Just because a stop in is a particular price doesn't mean we're going to get out at that price. And if we're doing a conditional order to exit on the stock price, we don't really know exactly what the option price is going to be that low at that price. We can kind of make some guesses, but there's that. We're also going to exit less than 10 days, DT, days to expiration. And that's in this class, we're going to do that. And one reason for that is, just remember, there is assignment risk. And this is the last one I'm going to write down here. I can't send out this document, but you're welcome to write it down or take a screenshot or whatever you want here. But let's consider that assignment risk for a sec. If I am doing an at-the-money short option, call or put, and the stock goes my direction, what's going to happen to that at-the-money short option? It's going to go in the money, okay? It's going to go in the money. Well, if an option is in the money, the odds of assignment risk go up, okay? Odds of early assignment go up if it goes in the money. So if things are going well, you got to be careful. Now, the more it goes in the money, probably the greater the assignment risk. The more it goes in the money, the closer you get to expiration, probably the more the early assignment risk. So that's why we're going to exit when we get with under 10 days to expiration, maybe a week to expiration there. So there's kind of some basic introductory type rules. No, I know rules is a bad word here. Just ideas for this class on back ratio spreads. But let's look at some example trades here on this. Okay, remember these are just examples. So let me move this out of the way. It will let me. There we go. And what I'm going to do is if it's a call, let's start with calls and we'll do a put example. But I'm going to pull up, I was looking this at earlier. Cisco has a nice upward trend. Okay, I think when I say nice, I mean over the past few months. It doesn't guarantee it's going to continue that way. we're above the 20 and the 50-day moving average. We've bounced off that 20-day moving average. We've had higher highs, higher lows. So the trend has been up on this. A lot of technicians would consider that to be more bullish there. So from that standpoint, we're going to do a bullish example trade. Obviously, you need to decide for yourself whether it's bullish or not, but let's use kind of the rules that we set forth as an example here on this, okay? So here's what I'm going to do. I'm going to go out, remember, think of your expectation. If I want this to be short term, maybe I'm only going to be in this a couple weeks, then I'll go to a shorter term expiration. If you think, oh, this is going to trend up for a while, I want to continue this, then maybe we'll do something a little longer term. In this case, I'm going to go out to 56 days. So I'm going to go out a little bit longer term on this. Okay. And let's do this here. Okay. So, first I'm going to go to my at the money. I'm just going to look for my at the money strike. Well, stock's at 66. We really are kind of in between those. I'll go the 65 call. I'm going to click on the bid price on that. Okay, I'm going to click on that 65 call. Now, I'm also going to go and I'm going to try and keep this zero extrinsic value. I'm going to do the whole zebra thing here on this one. Zero extrinsic value. Well, I'm not going to hit it perfectly, am I? Because this is 210. Two of these would be 260. But if I go to the 6250, that'll get us closer to that. So I'm going to buy 2 of these contracts. I'm going in the money. I'm going to, hold on. Let me do this on the, okay. Hold on. Let me go back here. I'm going to sell this one. I'm going to buy 2 of these. I'm going to hold down my control key. There we go. And I'm going to just make, now notice there's just one. I can either, there's 2 ways I can add another one on here. One, I can either do a control click on this again to add another one, or if I try and change it right here, it's going to change them both. But what I can do is I can just make that custom, and then it will make these independent of one another. And I can make this a quantity of 2. Okay. And let's analyze this page. So let me just analyze this trade, and let's just take a look at this. Okay. So here we go. This is what it looks like. This is what our risk profile looks like on this. Now, I'm going to go to, just see if I can get this. I want you to be able to see this trade down here. There we go. August 16th there. So let's hit our break even on this. I'm going to set slices, break even at expiration on there. And you can see our break even is around 66.50. Where's the current stock price? Well, the current stock price is just a little bit over 66. So we're pretty close. When I was talking about that kind of 50-50 probability, that's what I'm talking about. It's not exactly there. We're a little bit below the profitability range, but not much. But when we talk about also like unlimited upside, look, if I'm looking at this and I am, sorry, I moved my slice on there. But the more I scroll over, the more this goes up, the better. This is kind of like a stock in that regard. The more it goes up, the more money you make on this trade. Well, let's go down here. Look what happens here. We cap our downside on this. We're capping our downside on this. It gets worse and worse until we get to about 65 roughly, but then it doesn't get any worse. So potential gain is a lot more than potential loss. But of course, there's a downside too on this. And that is, the downside is your theta. Okay, your time decay is working against you on this trade. As I mentioned, it benefits in a positive implied volatility environment. And if we look at this, let me go back to my monitor tab, not my monitor. Let me go back to my trade tab. Let's go back here. And I'm just going to change this right now to theta. And I want to look at theta on these. And the theta on the short option, which is the 65, it's not going to be a huge difference because number one, we're rounding here, and we ended up with a strike price that is the one adjacent to the current strike price. And it's so there's not that much difference between these, but the theta on the short option is going to be higher. Typically, the at-the-money contract, if we're doing it the way we're doing it, the at-the-money contract is going to have a higher theta than the out-of-the-money contracts. So the time decay is probably going to be a little bit more beneficial to you and on this than if you just did a single long option on there. So that's one difference there to Chris, what Chris said. Now, Connie answered as well, but one answer is your theta is probably going to be less harmful, is maybe the better way, rather than say more beneficial, because it's not beneficial, it's going to be harmful. It's going to work against you. But your theta is probably going to be better for you in this situation than just a long call option. But this is fairly similar. This isn't that dissimilar from a long option here. What you can do is you can look at them side by side, and if you just do it on the Analyze tab and you separate these, you can kind of click them and check your break-even points on both of these here as well. But in terms of, as opposed to buying the stock, how much would 100 shares of this stock be? 100 shares of this stock would be about $6,600. What's our delta on this? Our delta on this is almost the same. It's almost 100. So almost 100 delta. For about the 10th of the price, roughly about the 10th of the price of the long stock. Okay, so that's a difference. That's a difference as well. And remember, when we're going to do this, we're going to decide what our exit point is. And what I'm going to say is, hey, look, if this breaks, I'll say below my moving, we'll say about below my 20-day moving average here, then my trend is being broken and I'm going to look to get out. So we're going to say below about 64, we're going to look to exit. And I'm just going to leave the top unbounded right now. At some point, we'll look to get out, but I'm going to leave that top side unbounded on this. So we're going to get out if we're below 64. So I'm going to make this, instead of a single order, just make it first trigger sequential. I'm going to right click on this. I'm going to create an opposite order. I'm going to make this a market, good till canceled. Now 64 may be a little tight. Let me give it a little more wiggle room here, because if it bounces down to my moving average, I'm okay. Let's go like 2% below that. And that's going to give me something closer to 63 is where I'm going to put that trade in. Usually I'll kind of find a support level and go a couple percent below that support level on these. So we're going to get out of this trade. Hold on. We're going to get out of this trade. What happened to my trade? Sec. Let me. Sorry, I got stuck on this. I don't know why I clicked off it and now my trade is gone on that. Did I miss it? Okay, well, we're going to redo it. We'll just redo that. But let me answer a question while I'm doing that. Vic says, so this is better than a long put vertical. I'm not going to say it's better, but it's different, okay? Remember, there's pros and cons to any trade you do. Comparing this to a long put vertical, and we'll look at some other long put verticals later in terms of trade management here. Long put verticals don't have unlimited. Remember, the more this goes up, the more money you're making. Long put verticals, or long call verticals for that matter, have much more limited upside potential there. Or long call verticals, yes, have much more limited upside potential. So from that standpoint, this is better in that regard. But we'll probably have more downside risk as well on that. So Vic, I would not say it's better. They're just different risk profiles on this. But this, from the standpoint of potential gains on this one is going to give you a potentially bigger move on this. Okay, let me just do this. Let me what's this? Okay, well, I sent it. I'm going to put in this. So here's our trade we just sent. And we said if it gets below 63, I'm going to exit. So I'm going to just right click on this, create a closing order, and goodness, I totally messed that up. No, there it is. That's my position on there. Hold on a sec. Cisco. Yeah, that's right. Okay. Let me right click, create a closing order on the whole thing. Okay, this is kind of strange. Okay, let's sell to the 65. There we go. So that's it. Okay. So, and we said we're going to get out of this if the stock goes below $63. So mark less than or equal to $63, and I'll get to questions here in just a sec. Okay. Save, confirm and send, and remember, when you send, make sure you read, I clicked through that a little quick, make sure you read the red lettering on that order ticket there. Okay. Let's see. Got it. And is this because we added additional positive delta? It's because, so Vic is following up on the long vertical versus this type trade. The answer is it's because we have an unequal number of contracts. We have an unequal number of long contracts. So it's not just the delta, it's that because on a vertical spread, every long contract is offset with the short contract. In this case, we have more long contracts than short contracts. Okay? So hoping that makes sense there to you. Okay? Sorry, I had a little struggle with that order entry there on that one a little bit. Let's look at something that is more on the bearish end of things. And so I'm going to find something that is trending down on this. I took T-Mobile, which has been trending down. We're below our 20-day moving average. We're below our 50-day moving average. We've broken down fairly substantially lately, below there, and we just keep going down. So I'm going to call this a little bit more bearish on this here. Okay. Now, let's look at this from a bearish end of things. Let me go here, and we go to T-Mobile. I'm not going to go out quite as long as this. I'm going to go out 28 days on this. We're going to do the same kind of formula we did before. And so we're going at the money. Well, nothing exactly out the money, but we got nothing exactly the same strike price, but as the stock price, but we have a 220 and we're going to sell that. We're going to go in the money and I'm going to go to my extrinsic value. I'm going to try to find my extrinsic value and go, well, look, this is two times this. We're going to do two of these 230 contracts. 2 times this is going to approximately equal the short contract here. So 220 was our short contract. I'm going to do 230 as my long contract. Okay? And so I'm going to make this custom. I'm going to give this 2 of these. And let's analyze this trade here. Let's analyze this trade. Actually, you know what? I want to do this a different way to just kind of compare just a long, we'll do just a long put versus this trade. So I'm going to go out of this for a sec. Let me go to the Analyze tab. And let's look at it from that standpoint. So I'm going to go to my my July 28th. I'm going to go to I'm going to throw in a short contract right here. We're going to sell that. And I'm going to look to buy 2 of these. And then I'm going to go to risk profile. And let's just kind of compare the 2 here on this. Okay. Let me just scroll this up. And let me uncheck this. Okay. So in terms of theta, my theta is about 5.5, working against me on this contract. If I just do a single long put, the theta is about above 7.5, 7.7. So there is a little difference there between doing the back ratio spread versus just doing the single long contract. Now, Terry in the chat said, just buy a call at a 97 delta. I could buy a call at a 97 delta, but if I'm looking at that, let's just kind of see what my risk is on that 97 delta call. Let me just flip this over. Well, I'll say put in this case because we're looking at puts. For me to get to 97, I don't have a 97 exactly. It kind of gets a little bit squampus on this, but we're looking at, we'll say roughly $5,000 risk on that trade. $5,000 risk on that. Whereas if I go here, my total price on that trade is, instead of $5,000, come on, is about $1,500 roughly, okay? Roughly $1,500. So significantly less risk doing it this way versus doing just a 97 delta call option there. There's pros and cons to both of them, right? There's definitely pros and cons to both of them, but just realize they're not exactly the same thing on that. Okay, so let's go back to let's look at some other differences here. Okay, delta on this versus delta on just doing one of the single long calls. Delta on this is pretty close to 97, pretty close to 100. If I just do that one long call on there, there's my 70 delta on that. So again, that would cost about roughly $1,000 on that to just do that one long put. And our time decay is a little bit higher. Again, there's pros and cons on this, but our cost is going to be a little bit more in terms of the back ratio spread on that. Let's look at our break even on this. let me go to set slices, break even at expiration is 222 is our break even. The current stock price on this is 222. So again, it's basically our break even is right where our stock price is. If I just do the long call, let's do the same thing. Clicked on the wrong thing. Set slices, break even. Break even is about 219. So you need a bigger move if you're just doing the single option versus that back ratio spread. So there we go. And this is where, and you can see where our profit loss areas are. So when we're considering this, we're hitting max loss at expiration at 230, okay? At 230. Now in the chat, Carrie said, can we do 3-to-2 ratios or something like that? Yeah, you can do 3-to-2. Let's look at this. And I'm not going to go through all of it just for time's sake, because I need to get going here. But bring it up on the Analyze tab. Go here, and I'm going to do 3 contracts of this. 2 + 1 is 3. And this is our 3-to-2 back ratio spread here on that, Harry. That's a 3-to-2 back ratio because we have more long options than short options. There's my long options. There's my short options. Compare max gain, max loss, and break-even point when you're comparing these trades one to another. Okay, compare those. I'm going to let you do that on your own time there because I'm running out of time and I want to manage it. Just a couple trades before we get out of this here. So there's that. Where are we looking to exit on this? I'm going to say if we break maybe back above 226, 2% is about $5 about it. So around 230, I'm going to look to get out. I'm going to look to get out about 2% above my old presumable resistance level. So about 230, I'm going to look to get out of this trade. So trade, we're going to do this, right click. We're going to create an opposite order. I'm going to do the same thing. I'm going to make this good till canceled. Did the same thing. It disappeared on me as soon as I went to good till canceled. I don't know why it's doing that. Well, I'm going to add that in after our webcast. I'm going to put that stop in above 230. I'm not sure why that is disappearing on me there. The other thing you can do, of course, is you can, it's so weird. I don't know why it's doing that. Is you can put it in after like I did on the other one. Okay. Let's just go. There's a couple trades I just need to manage because we're at expiration on them, basically. That's back ratio spreads, though, everybody. Just a reminder, here's the, the basics of back ratio spreads. We gave you a bullish example. We gave you a bearish example on them. And, there's pros and cons to every strategy, but consider this next time you're thinking of a long option or considering just a stock trade. There's pros and cons to this here on that. So let me just mention this. When we're looking at these trades, like long verticals, someone was asking about long verticals and comparing them. We're at expiration on these. On this Apple trade, it's expiring today, and one of these contracts is in the money here on this. It's a long contract, so there's not going to be any early exercise there on it, early assignment on that. But I don't want that to go all the way to expiration, and so I'm going to look to get out of this trade here. Okay, so we're going to close out of this trade. I'm going to create a closing order. We're going to sell that, and I'm just going to get out. Can send that trade. And let's do one more. Philip Morris, we've got less than 10 days to go to expiration. We're doing fairly well on this. and less than 10 days, about a week to go to expiration. Usually going to look to get out of these. I already have some sell orders on these. So what I'm going to do is I'm going to cancel those orders. Okay. That's the first step. I'm going to right click on this. I'm going to create this closing order on this. And I'm just going to get mid price 880. I want to get this filled though. So I'm going to go down a little bit below. I'm going to go between mid and natural. Click on confirm and send. Make sure you read the red, as I mentioned before, on all these trades. Read the order description, the break even, max profit, max loss. Just be aware of this. Your buying power effect of this trade. This is a closing order right now. And I'm going to send that and just get out of that, take the little profit that we got on that one there. Okay, so what did we do today? We talked about back ratio spreads. We talked about the basic rules of those. We talked about back ratio spreads as opposed to, say, just long verticals. We talked about it as opposed to long stock. And we also talked about it just doing a long versus just doing a long option. Whatever you do, just bring it up, pull it up on the Analyze tab and check out break even, max gain, max loss, and there you go. Next week, we'll plan on tackling front ratio spreads, which are a little bit different, in fact, quite different than these trades. But in the meantime, have a wonderful week ahead. Market Movers is coming up next at the top of the hour, so make sure you check that out. Thank you, Connie, for helping me out in the chat. And we'll see you all same time next week. Bye-bye, everybody.